Welcome to our video analysis of the world's luxury residential property hubs, brought to you by prime property market intelligence source Palatia.com. Over the last 20 years, a handful of cities across the world have emerged as global capitals, attracting a large slice of high-value international business. On the wake of this global business came ultra-high net worth and high net worth investors who began collecting the highest quality residential properties in these locations. As a result, the luxury property market in many of these cities has become increasingly disjointed from the domestic economy and more reliant on global affairs, finance and trade. But even though these world centers have more in common among themselves than with other cities in their own countries, the degree with which they attract international residential property investment varies enormously. In today's video, we will look at which factors draw wealthy, footloose property buyers and how each world city ranks against them. Next week, we'll explore whether the rise of emerging economies is likely to affect the geography of luxury property hubs, and if so, how. But what exactly is a world or alpha city? There are many definitions for it, listing anything from size and political importance to cultural dominance and socio-economic influence. But generally, all world centers share two traits. They are economic powerhouses, and they are the seat of major corporations and international businesses. More than 50 cities qualify as world centers. We have focused on 12 that have high global appeal and sizable luxury property markets. They are London, New York, Paris, Hong Kong, Tokyo, Singapore, Shanghai, Sydney, Moscow, Mumbai, Beijing and Geneva. All these cities draw demand from the local wealthy, but the ones that also manage to attract the greatest cosmopolitan interest truly dominate the market and are more likely to see their property stock retain its value over time or bounce back quickly after a dip. Being a world centre in itself is not enough to qualify as a global residential property hotspot. Several other factors come into play too, and the better a city scores against each of them, the stronger proposition it offers to the global wealthy. First and foremost is the degree of openness of the local property market. It sounds obvious that the more a city welcomes foreign investors, the more they're likely to buy there. But in truth, only very few world centres genuinely welcome international buyers, whereas others discourage or even forbid foreign property ownership. A confusing, hostile legal framework, or one where there is little clarity over title deeds, also acts as a dampener. As Liam Bailey of Knight Frank Estate Agents puts it, a global property hotspot needs to have a healthy economic base, but also transparency, governance and an open economy. You need to be able to buy there. Location is another important criterion. An easily accessible city that is well situated to conduct business internationally will trump a less well-positioned one. But the dynamics of each property market also matter. Factors such as, for example, the degree with which the quality and variety of the local property stock meets the expectations of the global elite, by offering a choice between new builds and older renovated homes, or between apartments and houses, but also the scarcity of stock compared to local and international demand, and therefore the robustness of resale prospects and capital appreciation all contribute to boosting a city's appeal. And in these uncertain times, a politically stable city where people feel personally and financially safe will always exert a compelling pull, and even more so if it has a lively cultural and social scene. As Giles Hanna of Christie's International Real Estate says, political stability is proving very important to buyers, as is infrastructure. So, how well do different world centres rate against these criteria? Well, at the moment, on the bottom rung are Mumbai, Beijing, Shanghai and Sydney. Although these are the new economic powerhouses of the roaring Asia-Pacific region, foreign access to their property market is limited or closed. Activity is often heavily influenced by government decisions. In Sydney, for example, foreign ownership rules were relaxed, then tightened within the course of 2 years between 2008 and 2010. As Liam Bailey says, people are potentially very interested in China and India, but you can't really buy there. And even if you can buy, the sheer fact that other people can't might put you off. Yolande Barnes of Savills Estate Agents points out that, given that appreciation of the property stock depends on the number of overseas buyers coming in, this might be limiting for people looking at Shanghai, Beijing or Mumbai, even though they themselves might be fortunate enough to be able to purchase a property there. One step up from these four are Moscow and Tokyo. The Tokyo property market is very firmly in domestic hands, with a minimal presence of foreign buyers. As a result, it is very dependent on the vagaries of the local economy. Tokyo, says Yolande Barnes of Savills, doesn't benefit from a significant amount of inward investment from overseas, and is exposed to fluctuations in the local economy rather than global wealth flows. This even applies at the billionaire end of the market, where buyers are usually very international in outlook. The situation is similar in Moscow. The city has a very high concentration of billionaires, but it is perceived as politically unstable and suffers from some degree of uncertainty over property titles. As a result, demand is almost all local and mirrors the commodity market that fuels it. Indeed, it is so closely linked to commodities that, in the words of Yolande Barnes, it is almost a proxy for commodity investment. By contrast, appetite for Singapore is strong, especially from buyers from the Asia-Pacific region, Chinese, Malaysians, Indians. However, the recently introduced additional buyer's stamp duty that targets foreigners acts as a deterrent to global interest. As Yolande Barnes of Savills points out, stamp duty is very high and stock is limited, so the global market in Singapore is smaller than you'd think. The story is much the same with Geneva. A solid history of political and financial stability makes the Swiss city extremely attractive to international buyers, but constraints on property purchases by non-resident foreigners mean the demand is chiefly from people who are moving to or already living in the city. Even more sought after is Hong Kong, which is far and away the most valuable market in emerging countries, and, according to some indexes, the most expensive in the world. It is also the gateway to and from China, and has been growing apace for the last couple of years, although it has now slowed down. All this ensures that demand for Hong Kong property is extremely high. Everyone wants a piece of Hong Kong, says Yolande Barnes of Savills. That said, the local market is notoriously volatile, and when it falls, it has a tendency to crash rather than land gently, making it a less than ideal choice for buyers looking for a safe haven. Almost on the opposite side of the world, cultural and artistic leadership, an open property market, a great location that serves as a springboard for other European countries, transparency of title and conveyancing all conspire to make Paris the main luxury property hub in continental Europe. Local demand is strong, but it's mostly for the lower brackets of the ultra-prime property market. The persisting euro crisis, on the other hand, is making some international investors more cautious, and the prohibition to wear burqas has put off some Middle Eastern buyers. Nonetheless, international appetite is nothing short of voracious. Tim Swaney of Home Hunts Estate Agents reports that Paris is seeing lots of demand for high-quality, renovated apartments in the most sought-after arrondissement, usually from Chinese, Middle Eastern and British buyers. Indeed, Parisian estate agents Daniel Feu have worked out that for properties priced above 10 million euros, only 15% of the buyers are French residents. One up from Paris, New York meets virtually all the criteria of a luxury property hub, but chiefly for condo properties, as co-op rules can be difficult to navigate for foreign buyers, condo and co-op being, of course, the two most common property ownership schemes available in the city. Foreign demand for luxury condo homes has risen in the last few years, contributing to the good performance of the condo market, whereas the co-op one has done less well. Liam Bailey of Knight Frank reports that at the top end, New York has lots of interest from European, Russian and Chinese buyers. Lately, South American investors have also arrived on the scene, branching out from their more usual preserves of Miami and LA. But when it comes to the top global luxury property hub, no place beats London. The British capital allows foreigners to buy property on the same terms as local residents, and is easily accessible, located as it is halfway between North America and Asia, which makes it perfect for business people. It also offers a safe haven for capitals and a safe, politically stable environment. It has a transparent legal system and a wide choice of high-quality apartments and houses with excellent resale prospects. So much so that, in the words of Liam Bailey of Knight Frank, London enjoys the most diverse buyers' interest from around the world, with nearly all nationalities represented. But we have entered what increasingly looks like the century of Asia Pacific. We are seeing economic supremacy shift from the West to the East. In this new world, will London, Paris and New York remain the world's global property capitals? Or will property investment move east too? Check palatia.com next week when we'll discuss whether and how the rise of emerging economies is likely to affect the geography of luxury property hubs. And don't forget to join the palatia.com mailing list to get the lowdown on luxury property markets around the world.